Welcome to Woods of Stardon. This is CH. I will be covering the PIMCO GIS Income Fund in this video, which is a refreshed version of the video I did last year. This is part of my Absolutely Biased Comments or ABCs series, whereby the aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The Pacific Investment Management Company, or better known as PIMCO, was founded in 1971 and has over the years established itself as a leading global asset management firm in active fixed income investing with deep expertise across public and private markets. PIMCO today manages over $2.2 trillion worth of assets from investors of all segments, supported by over 3,000 employees based in 24 office locations globally. PIMCO was acquired by Allianz SE in the year 2000, but runs as an autonomous subsidiary. Therefore, its product offerings are independent from other asset management businesses of Allianz. PIMCO offers a wide variety of fixed income managed products, with income-focused strategies being its specialty, and this is where the PIMCO GIS Income Fund falls under. The solutions are offered to clients globally across a full spectrum, from central banks and sovereign wealth, to pension and endowment, to family offices, to private and retail investors. PIMCO puts quite a lot of effort into understanding global macroeconomic and geopolitical changes in order to ensure their funds steer toward the right directions. This is helped by their Global Advisory Board, formed by ex-central bankers and ex-key government officials who can help guide the firm in this aspect. The Global Advisory Board members are updated periodically. Ng Kok Song, ex-CIO of Singapore's GIC and presidential candidate in 2023, used to be in this board as well. The PIMCO GIS Income Fund is a sub-fund under the PIMCO Funds Global Investors Series plc or PIMCO GIS fund family. PIMCO GIS is set up as an Irish ICVC company structure and is UCITS compliant. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The PIMCO income strategy was incepted in 2007 and was popularized in the few years after the 2008 financial crisis by taking a differentiated view and overweighted in the then cheap but unloved US mortgage-backed securities or MBS, and therefore outperforming most peers when the MBS market rebounded. This offered a different approach to income investing that deviated from the traditional government and corporate bonds and instead diversified into securitized assets and more complex credit structures to find opportunistic income sources. The two fund managers of the strategy, Dan Iverson and Alfred Murata, caught fame for their investment acumens and rose through the ranks in the firm. Today, Dan has become PIMCO's Group CIO, while Alfred continued to focus on investments and is a key portfolio manager for income-oriented, multi-sector credit, opportunistic and securitized strategies in the firm. Both of them continue to manage the PIMCO income strategy that has since evolved into PIMCO's flagship solution. Given the continued growth of the fund, Joshua Anderson, who specializes in global asset-backed securities or ABS, was added as a co-manager in 2018. The PIMCO income strategy has gathered significant client interest globally throughout the years and is currently the largest actively managed bond fund strategy in the world. The original US vehicle has over $212 billion of assets, while the international version has over 118 billion US dollars of assets. There are small differences between the two vehicles, but we will focus on the international version that is covered in this video. The investment objective of the PIMCO GIS Income Fund is stated slightly differently in the fund webpage versus the fact sheet and prospectus. What is clear is that the primary objective is to produce an attractively high level of income, presumably through distribution share classes. Capital appreciation is a secondary objective, meaning it is good to have but not a necessity. The fund webpage briefly mentions this is an actively managed solution that invests across a broad range of fixed income securities. It also states that the high level of income generation would be achieved while maintaining a relatively low risk profile. The fact sheet and prospectus, on the other hand, phrases it as prudent investment management that implicitly emphasizes on risk management within the investment process. Let's go through the prospectus to find out more. The Singapore prospectus states that the fund runs a global diversified bond strategy that can invest across regions, industries, issuers, and asset classes. It is stated that the fund will invest at least 2/3 of the portfolio in fixed income instruments, which provides some flexibility for the fund to invest beyond bonds if needed. This follows with a paragraph mentioning the different types of bonds the fund can invest in, including investment-grade and high-yield corporate bonds, government and agency bonds, securitized assets such as mortgage-backed securities and asset-backed securities, as well as FX investments. These investments can be from both developed as well as emerging market countries. Given this is PIMCO's flagship product and that it is managed by the group CIO, the best investment ideas from the different teams in the firm likely contribute to this diversified and unconstrained strategy. The prospectus then provides details on specific investment constraints. Here, it states the fund can invest max 50% in high-yield credit-rated bonds, max 20% in emerging market bonds, and max 100% in US government bonds. As mentioned earlier, the fund will invest at least 2/3 of the portfolio in bonds, which means up to 1/3 can be invested in equities-related securities as stated here. Of this, the fund can invest max 25% in convertible bonds and max 10% in direct equities. The fund can also invest max 10% into other funds if needed. For the more risky stuff, the fund can invest max 10% in illiquid securities, for example, distressed or defaulted bonds. The fund can also invest max 10% in insurance-linked products such as catastrophe bonds. While FX is part of the investment scope, the fund is base currency in US dollars and therefore has a constraint of max 30% in non-US dollar exposure. The fund can also use derivatives for investment purposes, though we will need to see later if the fund discloses actual derivative exposures in the portfolio for investors to understand the extent of the usage. Last but not least, the prospectus states that the benchmark of the fund is Bloomberg US Aggregate Index. While the fund can invest globally, using this index instead of the global version implies that the portfolio will likely be heavily exposed to US. The fund is, however, unconstrained by the benchmark in terms of investment exposures, so the benchmark is used only for performance comparison. While it is stated that the benchmark is not a performance target, I think it should still be used by investors as a reference for what the fund is expected to deliver in the long run. The main Irish prospectus interestingly has a longer version of the investment objective and policies, and I am not sure why the Singapore prospectus did not simply replicate the whole section and instead trim away some important stuff. Here are the additional paragraphs available in the main Irish prospectus, of which this is a paragraph talking about the fund using a top-down macro view combined with bottom-up security selection process, as well as stressing the importance of diversification in the portfolio construction. While brief, it at least gives investors an idea of the investment process. There is also a paragraph elaborating on the capital appreciation aspect of the fund, specifying the different situations whereby capital appreciation can happen. More importantly, it also reiterates that the income objective supersedes capital growth. Expected duration range is also mentioned here, spanning from 0 to 8 years. Last but not least, the Irish prospectus also further elaborate the usage of derivatives for investment purposes, in particular highlighting synthetic short positions to be actively used in the portfolio, with a constraint of a max 700% of the NAV for the combination of gross long plus gross short positions. It is also mentioned the fund uses value at risk or VAR methodology approach for investors who are more knowledgeable in financial risk calculations. Given minimal information provided on the investment process and the bond selection process, investors can only get some additional details via the insight articles whereby the fund managers talk about changes made in the portfolio in accordance to market conditions. There is a heavy reliance on top-down macro views, and rightly so, since the fund size is so large, the individual positions make minimal contributions relative to top-down adjustments to the regional and sector and duration exposures in the portfolio. As mentioned earlier, the PIMCO GIS Income Fund is the international version of the PIMCO Income Strategy. It was incepted in 2012 and currently has over 118 billion US dollars of assets. Base currency is US dollars, and the benchmark is Bloomberg US Aggregate Index. The way the fund presents its portfolio information may be a little complicated for retail investors. Country exposure-wise, the fund provides one version by FX percentage and another version by duration-weighted exposure percentage. Regardless of the version, it is clear that the portfolio has a significant weight in US, again signaling that this fund has a high US bias. The duration weight exposures provide some idea on the way the fund manages duration actively, through long duration on UK and Australia, and short duration on Germany and Japan. Negative exposures also imply the fund uses derivatives or leverage. Sector exposure is also presented in duration in the fund webpage and fact sheet, which is difficult for retail investors to appreciate. PIMCO used to provide a separate document called Sector Allocation Chart when I covered this fund last year, but it doesn't seem to be available anymore. Fortunately, the sector allocation by market value percentage can be found in the monthly fund commentary, though it is not as detailed as the old sector allocation chart. While the fund runs a global diversified and unconstrained mandate, it can be seen here that the fund has a very high exposure to securitized assets. The bulk of this would be agency MBS that the fund is well known to have a preference in. Corporate bonds of both investment grade and high yield look to have slightly higher allocations compared to about a year ago, while government bonds seem to have reduced in exchange for increase in emerging markets. From this chart, it seems that the fund currently doesn't have any equity exposures. The heavy exposures in US and in securitized assets is not a recent thing, as the fund has had these biases since inception. Therefore, investors who are looking for solutions that are not so concentrated in these two areas may need to think twice. A slightly dated sector allocation chart is actually found in a distribution rate change document, but it is dated October 2025 and seems to be updated only occasionally, so investors can't rely on it. As seen, this is really useful as it breaks down the exposures in much more details. I hope PIMCO can bring this back and add it into the fact sheet or commentary. The fund webpage also provides industry breakdown. Although this relates to the corporate bonds exposures only, that is about 23% in the portfolio. Maturity and duration breakdown are also provided, that both look quite diversified. The portfolio currently has an effective maturity of 6.79 years and effective duration of 4.83 years. The fund historically has been quite active in duration management to tackle interest rate risk and can reduce duration to near zero if needed. The fund doesn't provide credit rating breakdown, but we can find that in Morningstar. While Morningstar data is slightly dated at September 2025, the fund doesn't change too much across months given its massive size, so this is still pretty relevant. The fund has only about 7 to 8% high yield rated bonds, and these are actually spread across government, corporates, and securitized bonds as seen here. The bulk of the portfolio are AA rated from the government bonds and US agency MBS exposures. The resulting fund is a high AA- credit rating portfolio with a slightly cautious duration stance at the moment. Yield to maturity looks decently high at over 6% despite having only a small exposure in high yield bonds. So the fund has managed to find attractive yields in other exposures, notably the securitized assets it is overweighting in. The fund has over 6,000 holdings, which is expected given its massive size. Morningstar also shows quite a lot of short positions that implies active usage of derivatives. The fund fact sheet provides the top 10 holdings, but this is normally not too useful for bond funds with a large number of holdings. In this case, the top 10 holdings are dominated by Fannie Mae or FNMA agency MBS issues. For investors who like to dig deeper, the fund actually provides a full list of holdings in an Excel file based on last quarterly unaudited positions. In it, you will find thousands of line items, including details of all the bonds in the portfolio, as well as all the derivative swaps and FX contracts. Derivative usage information in the fund is typically not available to retail investors. Here is a snapshot of the information found in the quarterly investment report of the fund that is intended for professional and qualified investors only, just to get a feel on what goes on behind the scenes in the fund. We can see here the fund actively uses derivatives to invest in bond futures, interest rate swaps, credit default swaps, and various buy and sell options. The fund can, for example, use credit default swaps to replicate high-yield bond exposures without taking actual bond issue risks, or use interest rate swaps to adjust portfolio duration. With this information on the fund portfolio, investors should realize the fund is very different from both the Bloomberg US Aggregate Bond Index and Bloomberg Global Aggregate Bond Index. Both indices have about 50% in treasuries, and the Global Aggregate Index has only 40% US exposure. Again, investors who are looking for solutions that are more aligned to these indices may need to think twice. Given the PIMCO GIS Income Fund is a favorite across all client segments, the fund has a variety of client-type share classes and currency share classes available. Besides US dollars and Sing dollars, there are many other currency share classes as shown here. Non-US dollar classes are mostly currency hedged. PIMCO uses a term called unified fee that is effectively similar to total expense ratio or TER, instead of splitting management fees and other expenses. In terms of descending TER, the most common is the retail E-share class, followed by administrative class, then investor class, and finally institutional class. The TER range is big, from 1.45% of E-class down to 0.55% of Insti class. This means as an investor, if you are able to subscribe to the Insti class instead of the E-class, your investment returns is 0.9% higher every year. For a fund that delivers on average mid-single-digit returns, this is a significant amount. Distributors obviously potentially earn the TER difference as trailer fees, so most of the distributors tend to offer the retail E-class or at best the admin class. There are, however, some distributors that offer Insti class, so it is in your best interest to find them. Distributors are allowed to charge up to 5% subscription fee for the fund, although I think anything more than 1% for bond funds is excessive. While most share classes offer both accumulation and distribution versions, where I and C refer to distribution class, it is useful to note that the E-class and admin class in Sing Dollar Hedge only has distribution version. Investors who can only access these share classes and do not need the distributions should be able to opt for distribution reinvestment during subscription. Here is a 5-year Morningstar performance chart showing the client type share class differences in US dollars. Given bond investments tend to generate low returns, the TER differences can lead to meaningful return differences in the long run. As PIMCO GIS Income Fund is a popular bond fund and has a decently long track record for most of its currency share classes, I also like to use the fund to get an estimate on the different currency hedging costs for bond funds in general. Here is an example calculating the Sing dollar hedging costs by comparing the calendar performance differences between the base US dollar class and the Sing dollar hedge class. Distribution is obviously a key aspect of the PIMCO GIS Income Fund, given its main objective is to provide a high and consistent income. The fund provides quite a lot of different yield calculations, including portfolio yield to maturity, but these are not so important as they change on daily basis. Investors should focus on the actual distribution yield and the distribution amount to figure out the actual income received and how that relates to the overall fund performance. All the distribution share classes for the fund have a monthly distribution frequency. Using the latest 12-month yield data from Morningstar, we can see that there are some small differences in the distribution yield percentage across the different share classes, although they are around 6% or higher. This is because the fund adopts a smoothened payout policy on the payout amount, as seen here where the payout amounts are the same for the past months. As the NAV of different share classes move in different magnitudes, this results in a slightly different distribution yield percentage over time. I like it that the fund keeps it simple by applying the same distribution policy across all share classes, instead of trying to create a variety of share classes with different payout yields or frequencies that some other fund providers like to do. Investors should take note that having similar payout yield does mean that the TER differences, as well as the currency hedging costs, will all be factored into the NAV. The fund nicely provides a full historical chart of its distributions in a distribution rate change document. As seen, the fund fixed the payout yield at around 4% per annum since inception for many years. It only increased the payout yield in 2022, following the sharp interest rate hikes then, to the 6% levels that stayed till now. As this shows, the fund does try to keep the distributions consistent but can make adjustments in response to big market changes. It is therefore possible for the fund to reduce the payout yield if more interest rate cuts happen going forward. Investors should be aware of this and not assume the fund will maintain the 6% payout yield indefinitely. As mentioned earlier, capital appreciation is a secondary and therefore optional objective for the fund. We can see here that the retail e-distribution US dollar class NAV hasn't moved much over time since incepting in 2012, as the distributions comprise almost all the returns over the years. So investors are not going to see much capital appreciation, if any, in the distribution classes of the fund. That being said, the fund also makes an effort not to incur capital or NAV loss if possible. Using the same retail e-distribution US dollar class as example again, the NAV was maintained in a tight range while distribution was fixed at around 4% per annum yield. The sharp interest rate hike period in 2022 was an exception though, and caused some permanent NAV loss, which was not fund specific and impacted majority of the bond funds in the market. After interest rates became more stabilized, the fund adopted a new tight range for its NAV while increasing the distribution yield to the 6% levels to match the new market conditions. Now, the fund could have kept the yield at 4% and used that 2% difference to recover back the NAV, but this is not the intent of the fund, as income takes higher priority than capital appreciation for its objectives. This is important for investors to understand, as this is the strategy and objective of the fund, which gives a very different experience compared to investing in direct bonds. Performance data of the PIMCO GIS Income Fund is readily available in the fund webpage and fact sheet, showing data for calendar years and various time periods. I would first ignore the lines that include a 5% subscription fee, as that doesn't represent the fund's actual performance, and you should really change your banker if you get charged 5% for mutual funds. The fund managed to outperform the benchmark, that is Bloomberg US Aggregate Index, for 7 of 10 past calendar years between 2015 to 2024. While the fact sheet is dated November 2025, the fund actually outperformed in 2025 as well. This resulted in the fund beating the benchmark across all stated time periods of 1, 3, 5, and 10 years. Comparing the fund against ETFs representing various US bond market segments, it can be seen that the fund has outperformed all of them since incepting in 2012. HYG was noticeably weaker in the earlier years, but delivered strong returns alongside with the bullish equity markets, resulting in a return that is almost on par with the fund for this time period. The rest were lagging quite far behind, with AGG representing the fund's benchmark quite far off, as it is pulled down by the high allocations in US Treasury bonds. As the fund is more commonly used as a global bond solution instead of US bond solution, here is the comparison of the fund against ETFs representing various global bond market segments. Again, it can be seen that the fund has outperformed all of them since incepting in 2012. HYLD again is the closest in returns, though this global version is slightly weaker than HYG. The success of the fund in terms of its long-term track record shows that it is possible to have an actively managed solution that can outperform the broad bond markets decently, and is the main reason why the fund has been so popular with investors despite so many bond ETFs with cheaper fees available out there. On a shorter term basis, for example the 3-year chart as seen here, the fund does underperform some specific bond market segments. HYLD takes the lead given high-yield bonds are highly correlated to equities that has been very bullish in recent years. IEMB has also done well, and CORP has delivered just slightly less than the fund. There are no active funds out there that has a 100% win rate against the market, and the fund is not designed to specifically beat the high-yield bond or emerging market bond markets. Therefore, what is more important is that the fund can continue to deliver a relatively decent performance in the long run, as shown in the longer-term charts earlier. There are actually quite a lot of global diversified unconstrained bond funds in the market, and here are some of the popular ones comparing to PIMCO GIS Income Fund. In this 10-year chart, PIMCO has edged out slightly to be the winner, though JP Morgan, M&G, and Neuberger Berman are quite close behind. These managers have different market views that lead to different bond portfolios, showing there are multiple ways to achieve similar returns. Moving to a shorter 5-year chart, we can see how correlated these funds are. It also shows more clearly that while PIMCO is not necessarily the best performer each year, it has maintained consistently as one of the better performers. Last but not least, 2025 has been a good year for PIMCO GIS Income Fund, delivering more than 9.5%, and was well ahead of most competitor funds. With that, let's summarize our findings. PIMCO holds a high reputation as a global leading active manager in fixed income solutions. The PIMCO GIS Income Fund is PIMCO's flagship product and managed by its group CIO, which means there are high stakes in the firm to ensure the success of the product. This is the largest active bond fund in the market at well over 100 billion US dollars for just the international version. The very large AUM assures investors of the product stability. On the flip side, with a very large AUM, it does become harder for the fund to find meaningful investment opportunities that can positively impact the performance. For a popular retail product, the fund is widely marketed and understood by most investors as a global diversified unconstrained bond strategy that has a primary objective to deliver a high and consistent income. However, the actual strategy and implementation of the fund is highly complex, with significant exposures to asset classes such as securitized assets that may require advanced knowledge to appreciate the risk and reward considerations, and also significant usage of derivatives and very active management on duration, maturity, and FX positioning. While the fund's mandate is global, the actual portfolio is significantly overweight in US and is also benchmarked against the Bloomberg US Aggregate Bond Index. There is nothing wrong with this, as the fund manager may identify the US bond markets having more opportunities. But investors who are looking to diversify beyond US will need to consider this aspect. The fund has a strong long-term performance track record, exhibiting a superior risk-adjusted return compared to both passive ETFs and most other active bond funds. The fund has a wide range of share classes for different client types and currency requirements. Given this is a popular fund, it can be found in most distributors' offerings. Retail investors can try to find a distributor that offers lower TER share classes of the fund to achieve better returns. The fund currently has a distribution payout at around 6%, which is attractive in current market conditions. However, with interest rates declining, the fund may eventually have to adjust down the yield back to the original 4% levels. In conclusion, the PIMCO GIS Income Fund well deserves its crown as the most popular active bond fund in the industry. The consistency of its performance over time has helped the fund fend off competitors trying to replicate its success and take over the throne. Even with its staggering AUM, the fund remains a top pick as a core bond fund position in investors' portfolios. Investors should, however, be aware of its strong US bias and securitized assets bias in case these are not the desired exposures. This concludes my absolutely biased comments on the PIMCO GIS Income Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.